Today is August 12th, and this is the ADM Investor Services Weekly Market Wrap-Up. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, the Vice President of Grain Research at ADMIS, and Alan Bush, the Senior Financial Economist. Steve, let's start with today's grain report. The USDA came out with some numbers at 11 o'clock this morning. What did they say?
They basically said a record corn and soybean crop. And what was interesting about it is that the market broke on it and come back and basically close unchanged to a little bit higher. So when we dive into the numbers, the corn yields 175, it's a record. Bean yields almost 49, which is a record. They reduced this year's bean carryout because of higher demand, which could have been some support, but they raised next year's carryout in both corn and soybeans, and they raised the world carryouts. So I think what the market is saying, at least in the beans, the demand right now is a bigger plus than the supply is a minus. And over in the corn, it's interesting that they use an average ear weight that's a little bit above what people had expected. And if you plug in an average ear weight, the yield would actually be 169 and not 175. So you have some people out in the field that says, okay, if I look at an unhusked ear, that's one yield. But if I tear it down and look at maybe the top isn't quite finished, it might be another yield. And that might be why we rallied so at the end of the day and a little bit of short coming down, selling the back line. But in general, the report was bearish, and the market rallied on it.
And where do prices go from here, Steve?
I think we're stuck in corn in a trading range between big supply and big demand, and I think that it's going to be tough to trade over $3.50 in the corn in December, and maybe we test $3 if the farmer sells it at market. And that's one of the big unknowns. Is right now, cash prices are below break even for the farmer, and he really doesn't have the incentive to sell. Soybeans, an impressive day. It backed off from the 960 in the session low and ended up almost at 990. So I think beans might try to push above $10 to get little beans in the pipeline to satisfy the demand. Wheat market's stuck in a trading range. It's not going to do much, but you have a record short position in the wheat market. There could be some short-terming activity.
Over the past few years, farmers have increased their grain storage capacity to record levels, realizing that many farmers still have grain in storage from the 2015 harvest. Can the farmers store this year's crop as well?
I think when you look at the overall numbers, you would say yes, that he could store what's left from last year and what's he's going to grow. Now, if we look at this yield today, there's going to be some regions that won't be able to store the crop as good as others. Out in the western Midwest, I think they have plenty of storage to store the crop. When we look down in like the Southwest where they had a record wheat crop, they don't have enough room for the summer crops, and they've got rains, and they're going to have a big corn crop in like Kansas and that area. As you move further east and south, there's not enough storage for the crop. So you're going to see some piles like in Illinois and Indiana.
So what would cause them to sell at these lower prices?
Well, I think that if I plugged in a balance sheet of a 160 yield and I get a 220 yield, maybe I'll sell those extra bushels, especially when I don't have storage. The other thing would be that if I sit down with my banker and I've got a negative cash flow, he may want me to sell something just to pay the bills. Interest rates are low. That's one thing that's in their favor. They still have a very strong equity position because they own the farmland, but they don't have any cash flow. So that if the banker forces them to sell it, he's going to sell it.
So how can farmers exercise price risk management right now? What should they be doing?
I think that what most of them will do is the soybean price is above break even for the most part. And if he gets this record yield across the Midwest, he can sell his beans to pay for the bills that he needs to pay and then buy a call. And if the market goes up, he can take advantage of that. In the corn, he probably is going to try to store that. And so it's not really a place to buy a put, but as he trickles the corn into the market, he can replace it with calls. Because I think that from a corn standpoint, it's conceivable that we can rally corn $1 from the harvest lows into next spring when we have another weather scare.
Conversely, end users and commercials should be buying grain here.
I think everybody was waiting to see what happened. I don't think there's very much coverage in meal. The Chinese have been spending an active week in buying beans, almost 3 million tons, and they keep buying it. So they feel that 960 is a very good price. From a corn standpoint, there's not a lot of downside potential for an end user. So if you have positive margins, and if you haven't bought any corn, you should buy the corn now. The same thing in wheat.
Alan, let's talk about the greenback. What caused the U.S. dollar to fall so hard on Wednesday, and what is the outlook for the dollar now?
Well, in the overnight trade on Wednesday, it was rather shocking when traders came in the morning and they realized that the investment community reassessed the possibility of what the Fed might do this year as far as raising interest rates. In fact, the probability of a rate increase dropped dramatically from 48% down to 38%. So that caused the financial markets to move rather suddenly, and we had an adverse effect on the U.S. dollar. Since then, though, we have seen a dollar recover a bit, and you have to keep in mind that the Fed is still the only major central bank that is likely to raise interest rates, maybe not this year, but possibly in 2017. So we would expect the dollar index to gradually work higher, nothing dramatic, but to trend higher over the next year and a half or so.
The 30-year Treasury bonds have been under pressure since the first week of July, even though many of the world's central banks are in an easing mode and the Federal Reserve, as you say, may be slow to increase rates. Why is this?
I think what we're gradually seeing is the bullish influence of all of the central bank accommodation is starting to become outweighed by the inflation outlook. We're seeing a lot of countries in recent weeks showing increased inflation levels, and I think this is only going to continue, and I think acceleration of the inflation rate is probably going to be with us for the rest of the year and into next year. So I think that is a negative that will be with us and become more of a problem. So I would have to be trading the bonds from the short side on 2 to 3 full-point rallies.
Turning to the gold market, Alan, many analysts cited the UK Brexit situation as the main reason for the substantial gains in the gold market earlier this year. Now that the bullish influence of Brexit is less of a focus, what is supporting the gold market?
Well, for one thing, it appears that gold production has peaked last year. That is a driving force taking the gold higher. Many traders and analysts were looking at the Brexit situation and thinking that was the only bullish factor. It was not. I think what is the dominant influence, and we talked about this quite a bit earlier, is the inflation influence is with us again. It's not talked about very much by many analysts, but I believe that inflation is gradually going to accelerate, gradually become a bigger and bigger problem, and where better to be than in the precious metals, gold and silver, on the long side. So I'm looking at a buy area in the December gold, just about $8 lower, right around the 1332 is a major support. I'd be buying against that support level in December gold.
And finally, besides gold medalists Michael Phelps and Simone Biles and the entire U.S. Olympic team, what's hot and what's not?
Well, I think that, in my opinion, the grains will make a bottom and a harvest bottom. And because demand, especially in beans, is so strong, you could see bean spreads work. You could see market rallies. So beans probably is hot. And then I think that as long as you have a low interest rate market, the stock market will be hot.
Well, I would agree with Steve's analysis on the stock index. My two favorite longs are stock indices and precious metals, both of which are likely to be supported by rising inflation levels. So continue to buy stock indices on breaks and also precious metals on breaks.
Remember, the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you have questions or would like to learn more about risk management and the brokerage services at ADMIS, please visit www.admis.com.